Good day, fellow investors. My name is Sven Karlin, and today I'll talk about temporal diversification. There are various ways to diversify. Some say invest in the S&P 500. I find that the worst way to diversify because you are investing all your money in good companies, but in very expensive companies where everything depends on how the American economy does. And after 8 years of economic expansions, I find it highly unlikely that there will be another 8-year period where stocks just go up. So today I'll discuss how the big boys, especially Warren Buffett, diversifies. Let's go a little bit in history. Warren Buffett is famous for buying American Express in the 1960s amidst the oil scandal, when the stock price dropped 70%. He made a nice calculation. He saw that the brand, the company, is much more valuable whatever happens in the oil scandal, and he bought with 40% of his portfolio. He still has those stocks. So he bought those stocks when they were extremely cheap. Fast forward 20 years, Coca-Cola. He bought Coca-Cola stocks in 1988, just after the 1987 stock market crash. Coca-Cola's stock price was above $3 in 1987. Then, after the crash, it dropped to $2.20, $2.40. And as you can see, the bulk of Buffett's buying was done at that price range. So Buffett bought Coca-Cola in a limited amount of time. And when he bought Coca-Cola, he focused on buying only that stock. He consequently kept Coca-Cola. These prices in the chart are adjusted, and Coca-Cola's dividend now is about $1.4. So Buffett paid $2.20 and he now enjoys a dividend of $1.4 on those $2.20. That's a 60% return per year just from the dividend. But he was smart enough to buy when the stocks were cheap. Fast forward another almost 30 years now. This fall, Buffett was buying US Airlines. Why? Because the valuation was between 5 and 10. So he bought a big stake in each of the 4 US airlines. Now the stock price is almost double what he paid. But he waited for a period in time when the stocks were extremely cheap, and then bought a lot of it. Third example, Apple. Even if Buffett said that he doesn't understand technology, last year he started buying Apple when the price was around 90. He bought even more at 100, 110, 120. His bulk position was bought between 90 and 120. The stock price now is of course much higher. But you can understand what Buffett is doing. He is buying the cheapest stock at the moment, and he then holds that cheap stock with a high yield. His earnings yield for Apple will be above 10% on his purchases. His earnings yield on the airlines will be 15% on his purchases. His earnings yield on Coca-Cola is 50-60%, and I'm not even going to mention his earnings yield on American Express. So the key to proper diversification is to diversify through time. Imagine that you have $10,000 to invest per year. Now what you can do is to spread those $10,000 in an ETF, or you can use those $10,000 and buy just one stock per year. One stock. I'm sure that if you can buy only one stock, you'll make sure that that stock is the best stock the cheapest stock in relation to the value you can get that you can find on the market. And a year after, that stock will probably be much higher than what you paid. And if you do that 10 years in a row, you buy the cheapest stock. A year and a half ago it was commodities, then it was Brazil, then we had cheap stocks in China, then we had cheap pharmaceuticals, now we have cheap retail, so there is always something to buy on the cheap. So every year you buy only one stock. After 10 years you have a great portfolio of 10 different stocks, all bought at extremely cheap prices, with high yields that allow you to buy even more stocks in the 11th, 12th, 13th year just from the high dividend yields you receive. So diversifying through time allows you to buy on the cheap, buy into cheap sectors that will deliver huge returns in the future, just as Buffett is doing. Going back to the S&P 500 and what is Buffett doing, if we take a look at this picture, Buffett's cash pile has never been greater. He has 19 billion on his balance sheet. What is he doing sitting with 90 billion in his pocket? He's waiting. He's waiting for what? He's waiting for bargain prices. So that cash is not burning a hole in his pocket. He's just sitting tight. He knows a recession will come. He knows opportunities will arise, and then he will buy with 90 billion on the cheap, probably one or two stocks that he finds extremely cheap at that moment in time. Now you can choose to do as everybody else is doing, diversify by buying the S&P 500 of high quality US stocks that are extremely expensive now, with a valuation of 25, while Buffett is buying stocks with a valuation of 10 and below. Or you can diversify as the big boys do. It's your choice, your money, your life. If you like the content, please subscribe, and I'll see you in the next video.